One of the first ways to reduce capital gains tax is use salary sacrifice to superannuation. Now, we went into a fair bit of detail on this strategy in the last webinar, so if you want to understand this and how much this is salary sacrifice and when it works, when it doesn't, etc., go and check out the TTR 2015. That's cornerstonewealth.com.au/TTR. Stands for Transition to Retirement 2015, and that'll get you the recording of the previous webinar. It goes into a lot of detail, but effectively there's two scenarios here. One is where this is Joe, who's a salaried employee. He sold an asset, incurred a capital, so he's got a wages and interest of $80,000, incurred the $25,000 capital gain. He didn't salary sacrifice anything here, so his total taxable income is $105,000. His tax on that is nearly $29,000. So what Joe can do in this scenario is salary sacrifice some money. So, and salary sacrificing, we're talking about salary sacrifice into super. I know you can salary sacrifice other things, but we're talking about into super here. So what that does is, if he salary sacrifices, for example, $23,350. Under this example, we're assuming that he's under 50 years of age and his threshold is $30,000, not $35,000. If he was over 50 years of age, then rather than doing $23,350, he could salary sacrifice $28,350 because he's got a higher contribution limit. But in this scenario, we've said $23,350, which effectively comes off that taxable income, so brings it down from $105,000 to $81,650. Then the tax and Medicare levy is just under $20,000. You do pay 15% contributions tax on that $23,350, but that's less than his marginal tax rate. So the effective tax saving is $5,640. So you can see here, salary sacrificing for Joe is well worth considering. If he was over 50, he'd potentially save an extra $1,000 on top of that as well. So it might be up close to $6,500 in tax that he might save in this scenario.